All right. Matt, the mortgage guy, back for another rendition of common questions I'm getting in mortgage that I would like to share with you because I think they may be helpful. The $1 million question, should I be paying points? And I'm gonna get into detail in this video on why there's so many different variables to consider. Sometimes you should, sometimes you shouldn't, depending on not only the loan type, the loan product, the rate sheet, but you and your future plans, your goals, all that other stuff. So before I get into it, please, if you would be so kind, smash the like button. The YouTube algorithm, whatever the heck that is, something good happens, right? So like, subscribe, share this with whoever you think might benefit. And before we get into it, I know some people probably want an explanation of what do you mean by points. And so if you don't know what points are, here's the easiest way to describe it. I like to keep things as simple as possible. When you get a mortgage, you have the option to pay points, which basically means pay money up front to get a lower interest rate. So you're going to put more money out of pocket right now today, pay the lender to get a lower interest rate, which is going to give you a lower monthly payment on all your future mortgage payments. You either do one or the other. You either pay less today and have a higher interest rate, or you pay more today and have a lower interest rate. That's just how it works, no matter what people try to tell you. And so here's what I want to do. I want to go through what a rate sheet looks like, and hopefully, more than just me explaining it, me showing it and showing the numbers. If you're like me and a visual person, this is going to do it more justice than just my lips a-moving. All right, so without further ado, a $400,000 loan on a purchase. And I think I had the purchase price at $550-ish, 5.25, something like that. So we're 70 to 75% LTV, primary purchase. This is not intended to be an offer to lend, so just get that out of the way. NMLS number 1088993. This is just for educational purposes, just an example. Okay, so here's what people don't understand. When I price your scenario and I say, all right, Mr. Joe Buyer, you've got a 760 credit score, you're putting 25% down, and you're purchasing a home in this zip code, here's the rate sheet. It's not just like, what rate do I get? And you draw a rate out of a hat and it's like, oh, cool, I got me a 2.625. That's not exactly how it works. Based on your credit score, your down payment, property type, and some other factors, a rate sheet pops out. And that rate sheet, I didn't even give you the whole shebang. It's even bigger than this. But this one, for my example, 225 to 325. So when somebody calls good old Matt the mortgage guy and says, what's your rate? I go, whatever you want. This goes up to 2% on a 30%, or I'm sorry, on a 30-year fixed, which you would never want because you never want to pay as much as it costs to go to that rate. So let me explain that. 2.25 on the scenario I'm describing cost 3.2 points. 1 point is 1% of the loan amount. So every 1 point on this $400,000 loan equals $4,000 that you pay up front to buy down the interest rate. So 3 and 2 points, I did a lot of rounding here. So if the math doesn't exactly align, just know that I looked at the points, I guesstimated there, I looked at the cost, I guesstimated there, I rounded, close enough for government work. $12,800 up front. If you really wanted to in this scenario, you pay an extra $12,800 at closing and you get yourself a nice 30-year fixed, 2.25%. This is the principal and interest payment, $1,529. And what I'm going to do is I'm going to explain to you, you don't always want the best rate. You don't want to shell out a bunch of $2,021 to save money on your mortgage payment in 2027. Chances are you might not be in the same mortgage in 2027. That's one of the factors you want to consider why you might not want to. And so here's where I should have started. This interest rate is called the par interest rate. The par interest rate is the rate that doesn't cost any points. 2.75, 0 points, so it's 0 cost, and your principal and interest payment, this isn't factoring in tax and insurance, is $1,633 a month. Now you either go lower in rate and you pay, or you go higher in rate, and look at this, it's in parentheses, the points. We've got rate, points, cost, and principal and interest. In parentheses means credit. So yeah, I can give you a 3%, I'll give you 1 point in credit. That's $4,000. That'll go towards other closing costs. That'll go towards prepaying your taxes and insurance. That'll go towards title fees. That'll go towards whatever you want it to go towards. In turn, for the lender giving you this credit up front, they're going to charge you 3% instead of 2.75. So your monthly payment is $1,686 versus $1,633 on just the principal and interest. You're paying an extra $53 per month. Hopefully that makes sense. And so here's the thing. It's your choice. You get to pick. What I show consumers is that it's a law of diminishing returns more often than not. Because we can go up, we can get a better rate by 1/8, and it costs you 3/4 of a point, $3,000. The next 1/8 of a percentage point, look at that. It went up to 175. So it's a full point between those two. It's $4,000 to go there. Not necessarily always worth it. Same thing going this way, 1/2 point, full point, 1.5 up. That move from 3.25, from 3 1/8 to 3 1/4 was only 1/4 point instead of these 1/2 point jumps. Law of diminishing returns. So here is the answer to the question, do I want to pay points? If you take the par rate and use that as our baseline, this plus tax and insurance, we'll exclude that because it's going to be the same no matter what. No matter what rate you pick, your taxes are fixed, your homeowner's insurance is fixed. So just leave that out of the equation. And let's just compare 275 with 2625. These payments are $26 difference. And you've got a $3,000 cost. And you just do some simple math and you say, I think it would be the other way around. 3,000 divided by 26. And what would you call that? Roughly 110-ish? 110 would be 2960. So we'll just call it 110. That's a long time. 120 months is 10 years. So this is over 9 years. Over 9 years to break even on this $3,000 you spent up front. With inflation running hot, with tomorrow's dollars being less than today's dollars, do I want to spend today's $3,000 to save $26 a month? Me thinking no. A quick thing to think about there is if you're on a fixed income, if you're dead set, you're going to stay in this house for a long, long time, the reasons why you might consider paying points. In this scenario that I just showed, it doesn't make a lot of sense to buy points, to pay points. I'm not advising a client to pay points. But here's another caveat. Different loan programs, different loan terms, 15, 20, 30-year, investment property, single family, duplex, all these things that are different factors. This rate sheet is not always going to be exactly like this. Let's look at a rate sheet on an investment property. I wrote it super small, but I'll say it out loud. This is an investment property purchase. Same $400,000 loan. And 3.375 is the no point option. 3 1/4 is a 1/2 point. 3 1/8 is a point. 3% is 1.5. 2.875 is 2%. What I noticed when I pulled this rate sheet, you can go from 3.375 to 2.875 for 2 points. A full 0.5% better in rate for 2 points. If you went a full half a percent better over here, 2.75 to 2 1/4, it's 3.2 points. So it's different. Proves my point. Different for different scenarios. So on this one, you buy an investment property and you're a buy and hold investor. You buy this and you're telling me I'm never going to sell this. I want it to cash flow. I've got money now that I want to put down. I'm not worried about an extra $2,000 or $4,000 up front right now. I'm holding this thing forever. Then we might look at, okay, you've got 1768 versus 1686. You want to go down to 3% on your investment property. You don't mind spending the $6,000 up front. If you can't see, it's a 1.5 and it's $6,000 to buy it down to 3% investment property purchase. 1686 and 1768 using the no cost one as the baseline. That is a difference of $118. It's going to cost you $6,000. Man, why didn't I bring my calculator? about 550. It's going to break even in like 4 years. This I might be able to ride with. Investor tells me, yeah, I want to buy it down to 3%. I'll spend the 1.5. I mean, buy it down to 2.875 if you want. It's going to be similar math. It's going to be a savings of, oh, am I tripping? Rewind. One take, no edits, remember. 1686 and 1768 is 82. Ha ha! That was a real smoking deal the first time I did it. $6 grand divided by 82. Whew! Math, don't fail me now. 60, 70, call it 75. Rough math. 6-year break even. Not as good. But still, if you're telling me I'm staying here forever, I want the extra cash flow. This $82 a month means a lot to me because that's all I'm after. I'm not worried about $6,000 right now. I want the extra $82 a month. I'm gonna keep it for a long time. I'm okay with this 6-year break even. All right, do it. It's a lot better than this. 9-point-something year break even. But that's how you do it. And that's how you analyze, is it worth it? Know that it's not always going to be the same rate sheet. I might have a different rate sheet months from now. Lenders get to decide. Do we want to point them to par? Do we want to make this more affordable? Do we want to let them buy it down to 2.5? Lenders every single day change their pricing. And I remember years ago where there was some crazy circumstances where a better rate was a better price. Trying to steer that person towards that rate. They're trying to get more 2.625s. They're trying to, offer it a point in credit right here and only 0.75 credit right here, meaning, they're paying you more to take the 2.875 than take the 3. Weird stuff like that be happening in lending. So take a look, get the options, analyze it, do the break even, do what's best for you. Just that easy. Thanks for watching. If you made it this far, I truly appreciate you. Like, comment, subscribe, share, and that's it. Let me know what other videos you want to see. I'm happy to make them. Take care.